The global silver market experienced a catastrophic breakdown in price discovery mechanisms on December 29, 2025, resulting in an unprecedented $25 per ounce differential between spot prices in New York and Shanghai. At the market close, COMEX silver futures settled at $72.15 per ounce, while Shanghai Futures Exchange silver contracts closed at $97.30 per ounce, creating the widest geographic arbitrage gap in the history of modern precious metals trading. This dislocation represents not merely a temporary pricing inefficiency, but rather a fundamental fracture in the integrated global commodity market structure that has operated relatively seamlessly for decades. The implications extend far beyond silver itself, signaling potential systemic vulnerabilities in cross-border capital flows and international trade settlement systems. The collapse sequence began at approximately 9:47 a.m. Eastern Time, when COMEX silver futures breached a critical technical support level at 78 per ounce. Within minutes, algorithmic trading systems and momentum-following strategies triggered a cascade of sell orders that overwhelmed available bid liquidity. Trading volume in the initial 30-minute period exceeded 95,000 contracts, representing approximately 475 million ounces of silver, roughly half of annual global mine production, compressed into a single half-hour trading window. Market makers widened bid-ask spreads from typical levels of 2 to 3 cents to as much as 40 cents as they withdrew liquidity in self-protection. Multiple exchange circuit breakers activated, though these brief pauses failed to restore orderly trading conditions. Simultaneously, the Shanghai market exhibited radically different behavior. Rather than following New York's decline, Shanghai silver prices initially held steady before actually rising as Chinese state-owned enterprises and industrial consumers accelerated purchasing. This divergence intensified throughout the trading session as capital controls prevented Chinese investors from selling Shanghai positions to buy cheaper COMEX contracts, and Western investors found themselves unable to access Shanghai markets to exploit the arbitrage opportunity. By the close of Asian trading, the gap had widened to $25 per ounce, a spread that would require silver to physically travel from New York to Shanghai at a cost per ounce that exceeded the actual transportation and insurance expenses by a factor of 20. Historical precedent provides limited guidance for understanding this magnitude of geographic price dislocation in a globally traded commodity. During the 1997 Asian financial crisis, temporary price gaps emerged between regional markets as currency controls and credit freezes disrupted normal arbitrage mechanisms, but those gaps rarely exceeded 3 to 5% and typically closed within days. The 2008 financial crisis produced brief episodes of pricing disconnects in various commodity markets, but these reflected liquidity evaporation rather than sustained structural barriers to arbitrage. The 2015 Chinese equity market crash demonstrated the power of capital controls to create price divergence between mainland and offshore Chinese stocks, yet those were equity securities with inherent jurisdictional characteristics rather than fungible physical commodities. The current situation represents something qualitatively different, a physical commodity with standardized specifications, trading at wildly different prices in the world, as two largest economies with no immediate mechanism for convergence. The collapse sequence began at approximately 9:47 a.m. Eastern Time, when COMEX silver futures breached a critical technical support level at 78 per ounce. Within minutes, algorithmic trading systems and momentum-following strategies triggered a cascade of sell orders that overwhelmed available bid liquidity. Trading volume in the initial 30-minute period exceeded 95,000 contracts, representing approximately 475 million ounces of silver, roughly half of annual global mine production, compressed into a single half-hour trading window. Market makers widened bid-ask spreads from typical levels of 2 to 3 cents to as much as 40 cents as they withdrew liquidity in self-protection. Multiple exchange circuit breakers activated, though these brief pauses failed to restore orderly trading conditions. Simultaneously, the Shanghai market exhibited radically different behavior. Rather than following New York's decline, Shanghai silver prices initially held steady before actually rising as Chinese state-owned enterprises and industrial consumers accelerated purchasing. This divergence intensified throughout the trading session as capital controls prevented Chinese investors from selling Shanghai positions to buy cheaper COMEX contracts, and Western investors found themselves unable to access Shanghai markets to exploit the arbitrage opportunity. By the close of Asian trading, the gap had widened to $25 per ounce, a spread that would require silver to physically travel from New York to Shanghai at a cost per ounce that exceeded the actual transportation and insurance expenses by a factor of 20. Historical precedent provides limited guidance for understanding this magnitude of geographic price dislocation in a globally traded commodity. During the 1997 Asian financial crisis, Temporary price gaps emerged between regional markets as currency controls and credit freezes disrupted normal arbitrage mechanisms, but those gaps rarely exceeded 3 to 5% and typically closed within days. The 2008 financial crisis produced brief episodes of pricing disconnects in various commodity markets, but these reflected liquidity evaporation rather than sustained structural barriers to arbitrage. The 2015 Chinese equity market crash demonstrated the power of capital controls to create price divergence between mainland and offshore Chinese stocks, yet those were equity securities with inherent jurisdictional characteristics rather than fungible physical commodities. The current situation represents something qualitatively different. A physical commodity with standardized specifications, trading at wildly different prices in the world, as two largest economies with no immediate mechanism for convergence. The composition of market participants on each side of the divide reveals critical information about the sustainability of this gap. Analysis of COMEX positioning data indicates that the New York sell-off was driven primarily by leveraged hedge funds and commodity trading advisors who faced margin calls and systematic selling requirements. These participants operate under mark-to-market accounting and regulatory capital requirements that force liquidation during rapid price declines regardless of fundamental value assessments. Physical buyers, industrial consumers, and long-term strategic investors largely withdrew from the COMEX market during the collapse, waiting for stabilization before committing capital. In Shanghai, the opposite dynamic played out. State-owned enterprises acting under government directives to secure strategic commodity supplies dominated buying activity, supported by domestic investors, viewing silver as an inflation hedge and store of value superior to yuan-denominated financial assets. The arbitrage that should theoretically eliminate such price gaps faces multiple structural barriers. Capital controls restrict the ability of Chinese investors to transfer funds overseas to purchase cheaper COMEX silver. Western investors seeking to access Shanghai markets confront regulatory hurdles, limited broker access, and concerns about the enforceability of contracts under Chinese legal jurisdiction. Physical arbitrage, purchasing silver in New York and shipping it to Shanghai, faces not only transportation costs and time delays, but also export licensing requirements, import duties, and potential government intervention to prevent such flows. Financial arbitrage through currency and derivative markets encounters its own obstacles as the yuan-dollar exchange rate itself became volatile and forward currency markets widened their bid-ask spreads in response to the commodity market chaos. The technical infrastructure supporting global silver trading revealed fragilities that few market participants had anticipated. Settlement systems operate on different time frames, with Shanghai requiring physical delivery within specific warehouse locations, while COMEX operates primarily as a financially settled futures market. Clearinghouses in each jurisdiction have limited exposure to counterparties in the other jurisdiction, creating settlement risk that inhibits large-scale arbitrage even when capital controls permit it. Quality specifications, while theoretically equivalent, are verified by different assayers and certification systems that add friction to cross-border physical movement. This collapse and the resulting gap force a fundamental reassessment of assumptions about global market integration. The post-Cold War era presumed increasing convergence of markets, free capital flows, and arbitrage mechanisms that would maintain price consistency across geographies. The events of December 29th suggest that this integration was more fragile than believed, and that strategic competition between major powers can fracture even the most liquid and historically integrated commodity markets. The 25 price gap between U.S. and Chinese silver markets reflects profound structural differences in market architecture that extend far beyond temporary liquidity constraints or panic selling. The COMEX operates as a derivatives exchange, where futures contracts represent the primary trading instrument, with physical delivery accounting for less than 2% of total contract volume. Price discovery occurs through continuous electronic trading supplemented by open outcry sessions, with market makers and algorithmic traders providing liquidity in exchange for capturing bid-ask spreads. The Shanghai Futures Exchange, by contrast, maintains significantly higher physical delivery rates approaching 8 to 12% of contracts, with state-owned enterprises frequently taking delivery to satisfy industrial demand or build strategic reserves. This fundamental difference in market function, financial speculation versus physical commodity allocation, creates divergent price dynamics during stress periods. Trading hours themselves contribute to price fragmentation. The COMEX operates from 8:25 a.m. to 1:25 p.m. Eastern Time for floor trading, with electronic trading extending the window but experiencing reduced liquidity outside core hours. Shanghai's trading sessions occur during Asian business hours with limited overlap with New York markets, approximately 2 hours of simultaneous trading when both markets are active. During the collapse, this temporal separation prevented real-time arbitrage responses. By the time Shanghai opened and Chinese traders could observe New York's decline, capital controls and regulatory restrictions prevented them from selling Shanghai positions to capitalize on the gap. When New York reopened after the Shanghai close, Western traders faced similar constraints in accessing Chinese markets, creating a self-reinforcing cycle of price divergence. China's capital control regime represents the single most significant structural barrier to price convergence. The State Administration of Foreign Exchange maintains strict limits on outbound capital flows from Chinese citizens and corporations, requiring approval for foreign exchange transactions exceeding specified thresholds. While the government has gradually liberalized some restrictions in recent years, periods of market stress typically trigger rapid reimposition of controls to prevent capital flight. During the December 29th collapse, Chinese authorities apparently tightened approval processes for outbound investment applications, effectively trapping domestic capital within Chinese markets. This prevented Chinese investors from exploiting the arbitrage opportunity by purchasing cheaper COMEX silver, thereby removing a major source of potential price convergence pressure. The inverse problem affects Western access to Chinese markets with equal force. Foreign investors seeking direct participation in Shanghai commodity markets must navigate the Qualified Foreign Institutional Investor Program, which imposes capital requirements, regulatory approvals, and quota limitations. The China International Payment System, while expanding its international connectivity, remains far less ubiquitous than the SWIFT network that dominates dollar-denominated transactions. Banks serving as intermediaries between Western investors and Chinese markets face compliance burdens, counterparty risks, and potential sanctions exposure that discourage aggressive arbitrage activity. During market stress, these institutional frictions intensify as risk management departments restrict exposure and limit position sizes. Currency dynamics amplify the structural divide. Silver trades in US dollars on COMEX and in Chinese yuan on Shanghai exchanges. The yuan-dollar exchange rate, while less volatile than many emerging market currencies, exhibits significant short-term fluctuations that add uncertainty to any arbitrage calculation. Forward currency markets that would normally allow hedging of exchange rate risk widened their spreads dramatically during the collapse, making it impossible to lock in profitable arbitrage returns with certainty. Additionally, China's management of the yuan exchange rate through a daily reference rate system means that rapid currency movements can be constrained or amplified by policy decisions, adding political risk to what should be purely economic arbitrage trades. Physical commodity flows face their own constellation of barriers. China maintains strategic commodity reserves managed by the State Reserves Bureau, which can purchase domestic production or imports to support prices or build stockpiles. Export restrictions on domestically produced silver, while not absolute, create bureaucratic hurdles and delays that prevent rapid arbitrage through physical shipment. Quality certification requirements differ between jurisdictions, requiring assaying and documentation that adds both cost and time to cross-border movements. Insurance and transportation logistics, while manageable under normal conditions, become prohibitively expensive during market stress when counterparty concerns and delivery uncertainties rise. The time required to ship physical silver from New York to Shanghai, typically 25-35 days by container vessel, means that even when arbitrage appears profitable, price movements during the transit period create significant risk. Regulatory philosophy diverges fundamentally between the two jurisdictions. U.S. commodity markets operate under a framework emphasizing transparency, market-determined prices, and minimal direct government intervention in price formation. The Commodity Futures Trading Commission regulates position limits and monitors for manipulation, but generally allows market forces to determine pricing. China's approach integrates commodity markets into broader industrial policy objectives, with government entities actively participating as buyers or sellers to achieve strategic goals. During the collapse, this philosophical difference manifested in Chinese state-owned enterprises aggressively purchasing at elevated Shanghai prices to ensure supply security, while U.S. markets experienced pure price discovery through buying and selling pressure without government intervention. Information asymmetry compounds the structural barriers to arbitrage. Shanghai market data, while publicly available, often exhibits reporting delays and lacks the granular detail provided by COMEX systems. Western analysts struggle to obtain reliable information about Chinese government reserve purchases, state-owned enterprise hedging activities, or actual physical inventory levels in Chinese warehouses. Chinese investors face similar uncertainties about Western market dynamics, particularly regarding the activities of large speculative funds and the true extent of physical deliverable stocks. This mutual opacity creates risk premiums that widen bid-ask spreads and discourage aggressive arbitrage positioning. The clearing and settlement infrastructure reveals additional fragmentation. COMEX contracts clear through CME clearing, which maintains robust margining systems and risk management protocols integrated with Western banking infrastructure. Shanghai contracts clear through the Shanghai Futures Exchange's own clearinghouse, which operates under Chinese regulatory oversight with different margin requirements and default procedures. Cross-margining agreements between the two clearinghouses do not exist, meaning that an arbitrage position requires posting initial margin in both jurisdictions without offset recognition. This capital inefficiency significantly reduces the attractiveness of arbitrage strategies even when price gaps appear compelling. The convergence of these structural factors, capital controls, currency risks, physical logistics, regulatory divergence, information asymmetry, and clearing fragmentation, creates a formidable barrier to the arbitrage forces that should theoretically eliminate the $25 gap. Understanding these structural elements proves essential for assessing whether the current dislocation represents a temporary anomaly or a more permanent feature of an increasingly bifurcated global economic system. The $25 price gap creates distinct categories of beneficiaries and victims, with a distribution of gains and losses revealing much about the changing architecture of global commerce. Sophisticated trading firms, with established operations in both jurisdictions and the regulatory approvals necessary to execute cross-border transactions, occupy the most advantageous position. A select group of international banks and commodity trading houses maintain the infrastructure, relationships, and capital to exploit the arbitrage opportunity despite the structural barriers. These organizations possess yuan and dollar liquidity simultaneously, maintain warehouse facilities and logistics networks spanning both countries, and employ compliance teams capable of navigating the regulatory complexity. For these elite participants, the $25 gap represents potential profits measured in millions of dollars per day, assuming they can source physical metal in New York and deliver it into Shanghai contracts within acceptable timeframes and risk parameters. Chinese state-owned enterprises emerge as strategic winners despite paying elevated prices for silver in Shanghai markets. These entities operate under directives that prioritize supply security and strategic reserve accumulation over short-term profit maximization. Purchasing silver at $97 per ounce when global markets price it at $72 appears irrational from a pure economic perspective, but serves broader national objectives of ensuring adequate supplies for solar panel manufacturing, electronics production, and 5G infrastructure development. The Chinese government views commodity price volatility and potential supply disruptions as national security concerns, making premium payments for guaranteed supply access strategically rational. Additionally, to the extent that aggressive Chinese buying contributes to maintaining elevated Shanghai prices, it supports domestic mining operations and serves industrial policy goals of developing indigenous production capacity. Industrial consumers operating exclusively within single jurisdictions face dramatically different outcomes based on their geographic location. Chinese manufacturers requiring silver inputs for electronics assembly or solar panel production confront input costs 35% higher than their American competitors, creating immediate competitive disadvantages in global markets. A Chinese solar panel manufacturer paying $97 per ounce for silver sees its production costs rise substantially compared to an American competitor sourcing at $72 per ounce. This cost differential, if sustained, will drive shifts in manufacturing location decisions, supply chain reconfiguration, and potentially government subsidies to offset the competitive disadvantage. Conversely, American manufacturers gain windfall cost advantages that improve margins and competitive positioning, though they face uncertainty about how long such advantages will persist. Leveraged speculators who maintained large short positions in COMEX silver captured extraordinary profits during the collapse, particularly if they recognized early that the Shanghai market would not follow New York's decline, and therefore that the gap would persist rather than quickly close. Hedge funds employing momentum strategies and systematic trend-following algorithms benefited from the violent downward move in COMEX prices. However, these same strategies faced catastrophic losses if they attempted to short Shanghai markets expecting convergence that never materialized. The divergence between the two markets destroyed traditional correlation-based trading strategies that assume price movements would remain synchronized across geographies. Quantitative funds relying on historical relationships between U.S. and Chinese commodity prices experienced significant drawdowns as their models failed to account for the possibility of sustained structural divergence. Long-term strategic investors and pension funds with diversified global portfolios find themselves trapped in positions with uncertain valuations and limited exit options. A U.S. pension fund holding silver mining equities must assess whether share prices should reflect the 72 COMEX price or the 97 Shanghai price, given that mining companies sell into global markets. Chinese pension funds and insurance companies holding silver as inflation hedges experience mark-to-market gains based on Shanghai pricing, but face the troubling reality that their silver holdings cannot be easily monetized at those elevated prices if they need to rebalance portfolios or meet liability obligations. The gap creates valuation uncertainty that complicates portfolio management, risk assessment, and regulatory capital calculations for financial institutions in both jurisdictions. The geopolitical dimensions of the collapse and sustained price gap extend well beyond commodity markets into the realm of strategic competition between the world's two largest economies. The event demonstrates that decades of economic integration and market connectivity can fracture rapidly when national interests diverge and governments prioritize strategic autonomy over economic efficiency. For U.S. policymakers, the collapse raises questions about the vulnerability of American commodity markets to foreign manipulation or strategic resource denial. Chinese authorities view the episode as validation of their push for commodity pricing mechanisms denominated in yuan and settled through Chinese financial infrastructure, reducing dependence on dollar-based systems. The fragmentation of the silver market provides a template for potential future disruptions in other strategic commodities, including rare earth elements, lithium, cobalt, and semiconductors. Multinational corporations with operations spanning both economies face acute treasury management and operational challenges. A company with manufacturing facilities in both countries must decide whether to hedge silver price exposure separately in each market, or attempt consolidated hedging strategies that may prove impossible to execute given capital controls. Transfer pricing between subsidiaries becomes problematic when the same commodity trades at wildly different prices in different jurisdictions, creating tax planning uncertainties and potential disputes with revenue authorities. Long-term supply contracts negotiated before the collapse now contain pricing provisions that reference markets trading at dramatically different levels, creating contractual ambiguities and potential litigation. Corporate finance departments designed for a globally integrated economy must rapidly develop capabilities for operating in a bifurcated world, where the basic assumption of price convergence no longer holds. The systemic risk implications warrant serious attention from financial regulators and central banks. If the $25 silver gap persists or widens further, it signals the potential for similar fractures in other commodity markets, currency markets, or even sovereign bond markets. The mechanisms that global financial institutions rely upon for risk management, diversification, hedging, arbitrage, break down when prices for identical assets diverge across geographies without convergence mechanisms. Counterparty risk intensifies as uncertainty grows about which jurisdiction's prices represent true economic value, and which might be artificially supported or suppressed. The probability of defaults on derivatives, contracts, margin calls that cannot be met, and cascading liquidity crises increases as market fragmentation deepens. Historical episodes of major financial market dislocations, the 1998 long-term capital management crisis, the 2008 Lehman Brothers collapse, frequently began with seemingly isolated pricing anomalies that metastasized into systemic events as interconnected exposures became apparent. Early warning indicators that market participants should monitor include several key metrics. The spread between COMEX and Shanghai silver prices itself serves as the primary signal. Widening beyond $30 would indicate accelerating fragmentation while narrowing. Below 15 would suggest potential convergence. Capital flow data from both U.S. and Chinese authorities provides insight into whether controls are tightening or loosening. Physical silver import and export volumes reveal whether arbitrage through commodity shipment is occurring at scale. Currency volatility and forward market pricing indicate expectations about exchange rate stability that directly affect arbitrage profitability. Policy announcements from commodity regulators, central banks, and trade ministries offer signals about official attitudes toward the market dislocation and potential interventions. Most critically, the behavior of silver mining equity prices provides information about which jurisdiction's spot price the equity market believes represents sustainable long-term value for the industry. The persistence of the $25 price gap requires investors and business operators to abandon assumptions about global market integration and develop frameworks for navigating a bifurcated commodity landscape. Scenario planning becomes essential rather than optional, with three primary trajectories warranting detailed analysis and probability assessment. The base case scenario assumes the gap persists in the $20 or $30 range for 6 to 18 months before gradual convergence. As capital controls ease incrementally, physical arbitrage slowly equalizes supply-demand imbalances, and political tensions between the U.S. and China stabilize sufficiently to restore some degree of market integration. This scenario assigns roughly 50% probability and suggests positioning strategies that capitalize on sustained divergence while maintaining flexibility to adapt when convergence begins. The bull case for rapid convergence within weeks carries perhaps 20% probability and would require coordinated policy action from both governments, dramatic easing of capital controls, or a breakthrough in diplomatic relations that reduces strategic competition. The bear case, assigned 30% probability, envisions gap widening to $40, $50 as economic decoupling accelerates, capital controls tighten further, and both nations prioritize strategic autonomy over market efficiency. Access and execution capabilities determine which participants can capitalize on opportunities the gap creates. Investors and corporations without existing operations in both jurisdictions face significant hurdles in establishing the necessary infrastructure. Opening brokerage accounts with access to Shanghai Futures Exchange requires navigating the qualified foreign institutional investor approval process, which involves minimum capital thresholds typically exceeding 50 million, extensive documentation, regulatory approvals that can take 6 to 12 months, and ongoing compliance obligations. Alternative approaches include partnering with Chinese joint venture partners who possess domestic market access utilizing offshore yuan-denominated instruments traded in Hong Kong that may partially track Shanghai prices, or gaining exposure through equity investments in Chinese mining companies or commodity trading firms. Each alternative introduces additional complexity, counterparty risk, and basis risk that reduces the attractiveness of arbitrage strategies. For most individual investors and smaller institutions, direct participation in exploiting the gap remains effectively impossible, leaving them as price takers in whichever market they can access. Physical arbitrage through commodity shipment represents the theoretically most straightforward convergence mechanism, but encounters practical obstacles that limit its effectiveness. Purchasing silver at 72 per ounce in New York and shipping it to Shanghai for sale at 97 appears to offer 25 per ounce profit, but the reality proves far more complex. Transportation costs via container vessel average $1.50 to $2 per ounce, including freight, insurance, and handling. Chinese import duties on silver currently stand at 17% of declared value, immediately consuming approximately $12 per ounce of the apparent profit. Export licensing from the United States, while generally available, requires documentation and potential delays. Quality assurance and reassaying in China adds another 0.75 1-hour risk from 25 per ounce. Most significantly, the 30-40-day transit time exposes the arbitrageur to price risk in both markets. Shanghai prices could decline, or New York prices could rise during shipment, eliminating profits or creating losses. Forward hedging that would lock in profits requires access to both futures markets and willingness to post margin in both jurisdictions. After accounting for all costs and risks, the effective arbitrage opportunity shrinks to perhaps $8 to $10 per ounce for organizations with optimal infrastructure, and disappears entirely for those lacking established logistics networks. Hedging strategies for companies with cross-border operations require fundamental rethinking of traditional approaches. A multinational manufacturer with facilities in both countries previously could hedge consolidated silver exposure through a single COMEX futures position, confident that prices would remain roughly aligned globally. That assumption no longer holds. The company must now decide whether to hedge each jurisdiction's exposure separately, accepting the operational complexity and capital requirements of maintaining positions in both markets, or to hedge only in one market while accepting basis risk in the other. If Shanghai prices consistently exceed COMEX prices by $20 or $30, hedging only in New York leaves Chinese operations exposed to higher input costs that may not be fully recovered through hedging gains. Conversely, hedging in both markets requires the organizational capability to monitor two distinct markets, manage margin requirements in both jurisdictions, and navigate different regulatory regimes. Treasury departments built for globalized markets find themselves understaffed and under-resourced for this new bifurcated reality. Supply chain and operational adjustments represent the most consequential strategic responses for corporations in affected industries. Manufacturing location decisions must now incorporate the reality that input costs may vary by 30% or more based purely on geographic access to different silver markets. A company planning to build a new electronics manufacturing facility must weigh Chinese labor costs and market proximity against dramatically higher silver input costs compared to locations with access to COMEX pricing. Existing facilities face pressure to reconfigure supply chains, with Chinese plants seeking alternative materials or design modifications to reduce silver consumption, while US-based plants potentially increase silver usage given cost advantages. Procurement strategies shift from just-in-time delivery towards strategic inventory building when favorable pricing opportunities emerge in accessible markets. The premium that companies place on supply security and price stability increases relative to the pursuit of absolute lowest cost, driving longer-term contracts and strategic supplier relationships despite sacrificing some flexibility. Policy monitoring becomes a critical operational capability requiring dedicated resources and expertise. Key indicators demanding continuous surveillance include official statements from the People's Bank of China regarding capital account liberalization timelines, announcements from the State Administration of Foreign Exchange about quota modifications, U.S. Treasury Department positioning on strategic commodity security, congressional activity related to trade policy or sanctions, and commentary from international organizations like the IMF regarding currency convertibility and capital flow management. Real-time monitoring of regulatory changes allows rapid strategic adjustment when policy shifts create opportunities or necessitate risk reduction. Companies and investment firms that previously required only periodic attention to policy developments now need staffing and systems for constant monitoring across multiple jurisdictions and policy domains. Long-term strategic positioning requires accepting that market bifurcation may represent not a temporary anomaly, but rather the new structural reality. Strategic competition between major powers shows no signs of abating and may intensify across multiple dimensions, including technology, finance, and commodity security. Organizations that build capabilities for operating effectively in fragmented global markets, maintaining relationships and operations in multiple jurisdictions, developing sophisticated cross-border risk management, cultivating political and regulatory intelligence networks, will hold competitive advantages over those still optimized for the previous era of seamless global integration. This argues for investment in dual market infrastructure, even when current operations might not strictly require it, building optionality for navigating various future scenarios. Risk management discipline proves essential given elevated uncertainty and potential for gap volatility in either direction. Position sizing should reflect the reality that traditional risk models built on historical correlations and volatility patterns no longer apply when markets can diverge by 35% for sustained periods. Stop-loss disciplines designed for normal market conditions may prove inappropriate when structural barriers prevent price convergence. A stop-loss triggered by normal volatility could force exit from positions that would ultimately prove profitable as sustained arbitrage opportunities emerge. Conversely, stubbornly maintaining positions in hope of convergence that never materializes can destroy capital if the bear case scenario of accelerating fragmentation prevails. The balance requires dynamic risk assessment that monitors both technical price levels and fundamental shifts in the political and regulatory environment that govern capital flows and market access. The synthesis of this analysis yields a strategic framework emphasizing adaptability, infrastructure investment, and scenario-based planning. The December 29th collapse and subsequent 25 gap signal, not merely a commodity market dislocation, but rather a fundamental shift in global economic architecture toward greater fragmentation along geopolitical lines. Winners in this environment will be organizations and investors that recognize the shift early, build capabilities for navigating bifurcated markets, maintain discipline in risk management, and avoid the paralysis that comes from hoping for a return to previous norms. The gap may narrow over time, but the structural forces creating it, strategic competition, capital controls, divergent regulatory philosophies, appear likely to persist and potentially intensify. Strategic positioning begins with accepting this reality rather than fighting it.